What is up, everybody? Dan again, Stocktrades.ca. Welcome back to the YouTube channel. We're going to be going over a very niche fund in this video. It is one that Canadians are wondering whether or not the sector has bottomed as of late, or if there's more downside, or more importantly, if lowering interest rates will actually cause some, outperformance moving forward. And that is the real estate investment trust sector. And we're going to be going over BMO's product, ZRE, in this video. It's got a very unique structure to it in terms of top holdings, and a lot of these REIT ETFs, a lot of people think they're, apples to apples. They're mostly the same, but they contain very, very different strategies, I would say, in terms of how they allocate their funds, in particular to which real estate sectors. So in this video, I'm going to dive right into ZRE so that you can know the overall strategy this fund is aiming to achieve and how I feel it will do moving forward in the future. With that said, let's jump right into the video. As always, everybody, head down below, like the video, subscribe to the channel, comment. Next week, I'm going to be giving away a brand new subscription to Stocktrades Premium, $300 a year platform, absolutely free, but you got to comment to be entered. And most importantly, we are launching a massive ETF initiative over at Stocktrades. You're going to want to head down below and join the No BS newsletter. It's a 2x a week newsletter we send out to over 25,000 Canadians. Case studies, market research, stock picks, ETF picks, all that type of stuff, but you can't get it unless you're subscribed. Head down below. The link is in the description. It's absolutely free, and it's going to help you get more out of your portfolio. So let's get into ZRE. So there's pretty much no doubt that REITs have taken a very big step back over the years. I mean, even when we look to the performance of a fund like ZRE, we can see that it performed quite well leading up to the COVID pandemic, primarily because of low interest rates. I mean, we were in a very low interest rate environment. The housing issues we have here, notorious housing issues in Canada, causing, asset prices, property prices to increase by significant amounts. And I mean, this was even amplified, as you can see here, post-pandemic. Well, actually not, I wouldn't say post-pandemic, but during the pandemic bubble when policy rates started to rise significantly. And I'm actually going to show you how policy rates have impacted the price of this ETF. When I look over returns, it's going to highlight some pretty important concepts when it comes to rates and REITs. But the BMO Equal Rates Index ETF, so pretty much what it aims to do, it's an index fund that aims to track the selective equal weight Canada REIT Index. Now, remember when I said these REIT ETFs are not apples to apples? A lot of people kind of make the assumption that they're all the same, but when we look to a fund like VRE, which is the Vanguard REIT ETF, this tracks the FTSE Canada All Cap Real Estate Index, capped at 25%, so no holding can make up 25%. Now, I'm going to compare VRE with ZRE down the line in terms of holdings, so it's going to give you a comparison on these two funds and how differently they're structured and, just overall how it's impacted performance. But back to ZRE, it is, it's one of the more popular REIT ETFs in the country. It has assets under management of 528 million. None of these funds are going to be very large in size just because of the Canadian market. We're typically smaller, and as a result, the fees are a bit higher. Now, this is a niche ETF. It collects, I believe it's 20 some REITs, 25 REITs, and, pools them together for investors to get exposure to. So as a result, they can get away with charging more fees. We're looking at fees of 0.61%, but when I look to the actual ETF fact sheet, let's go down and look at the trading ratio. So we can see the fund is 0.63. So there's a 0.61 management expense ratio and a 0.02 trading expense ratio. This is not all that surprising considering this is an index fund. There's not going to be a lot of trading costs involved with the fund. It's just going to track the index and make changes when the index does. So total fees of 0.63, meaning you'll pay around $6.30 per thousand invested on a yearly basis. So the fees are quite high. A lot of the times, as I've mentioned numerous times, fees are relative to performance. If you have a high fee fund, you could have a fund that's, it has fees of 3%. If it's posting strong returns, this fee could be worth it. Remember, you want to look at fees, performance net of fees, and then judge whether or not that fee has been worth it. We'll talk about this particular fee and whether or not it's been worth it moving forward. REITs are not very tax friendly. They don't pay eligible dividends primarily because of the way they're structured. They're structured as trusts. They have to pay out a huge chunk of their net income as profits, and they get a bit of tax breaks in a way, and as a result, they're not eligible dividends. You can get some REITs that will pay eligible dividends, a chunk of the distribution, but the most important thing to understand is the vast majority of REITs and these REIT ETFs are not going to be eligible dividend income. So when we looked at the actual dividend yield on a historical basis, this fund, it has yielded higher, especially when, REITs were facing a really heavy drawdown. The COVID-19 pandemic obviously was peak yield, but we can see that the fund is, it's generally yielding in line with averages despite, a pretty big drawdown in price. So this was actually relatively interesting to me. I would expect the fund to be yielding, especially because we're looking at, large drawdowns from peaks. We look to March 9th of 2022. That is when this hit absolutely peak rates. And again, what happened in, March, April 2022? Policy rates started rising. And then now we're looking at, $20.16. So that is quite a big drawdown. Now, I typically go over the valuation of these funds, but with a REIT ETF, it's going to be pointless. I mean, we can look at a PE ratio of 13, but price to earnings is not that important for REITs. You're going to want to look at funds from operations, adjusted funds from operations, and revenue. I mean, when we look to growth rates, we can see that, it's not necessarily the most important indicator, so I'm going to completely skip this part. So when we go to risk, when we look to, let's just span it out to 5-year risk, because I feel this is, more relevant than going out to, say, 10 years. I mean, when we span out to 10 years, the max drawdown is relatively the same. The alpha, which is essentially how the fund has outperformed over the last while, you want a positive alpha. This is negative 2.6, suggesting that the fund hasn't really performed all that well over the last 10 years. It tracks the market relatively well, beta of 1.02. But when we go to the last 5 years, we can see an alpha of negative 9.8, a beta of 1.17, suggesting the fund is getting more volatile. And we look to the max drawdown, which I would almost guarantee is COVID-19 pandemic. Yeah. We can see that prior to the COVID-19 pandemic, this fund had a max drawdown of only 19%. But when we looked at COVID, 46%. So this fund lost, nearly half its value in the COVID-19 market crash. I mean, look at the chart. It practically fell off a cliff. Now, this fund does have a lot of residential real estate exposure, which is primarily why it collapsed like this. Now, pretty much all REITs collapsed, but residential was a bit more exposed because a lot of people thought, these tenants aren't going to be able to pay their rent, things like that. Now, I know I usually go over the allocations. This fund is going to be very straightforward. I'll actually get more into the makeup of it in the holdings portion, but I mean, it's a 100% REIT fund. Most of them are mid-cap and small caps, but this is only because most of our real estate investment trusts are going to be mid-cap and small caps. Like these mid-cap value and mid-cap blend plays, they're going to be some of the largest REITs in the country. It's just, this is decided based on market cap. So we don't have a lot of large cap REITs in Canada. So this is why you're going to see things like this on the allocation chart. Now, when we go to holdings, what I do want to highlight is that this is an equal weighted ETF. And I actually looked up the benchmark statement here to just show you how exactly this ETF makes up its total holdings. So the selection of securities, they have to trade on the TSX. They have to be a real estate investment trust. For new index components, there's a minimum market capitalization of at least 800 million. For current index components, the minimum market capitalization must be at least 500 million. So it takes 800 million to get on the index, and then there's some leeway. It can drop below 800 million, but once it gets below 500 million, they will remove you from the index. And so for new index components, there must be average daily trading volume of Canadian 1 million. So this is total volume, dollar volume, not necessarily share volume. And for index components currently in there, they need to have minimum daily traded volume of 750,000. So if they get on the index, volume drops to the point where the index doesn't feel the fund is liquid enough, it will remove it from the index. But for the most part, you're going to get equal weight exposure to a wide variety of REITs here in Canada. Now, the overall holdings here, we're seeing Northwest, they just cut their distribution. They're, medical centers, things like that. Artis Real Estate is an office REIT. Granite would be industrial, Dream Industrial. Chartwell, that's a retirement residence. The top holdings aren't necessarily all that important because the fund is going to, for the most part, have equal exposure to all these funds. But the one important thing you can note here on the side here is that this is 36% retail REITs, 26% residential REITs, and 14% industrial REITs. Now, depending on your overall outlook of the REIT sector, I mean, this could be a benefit for those who believe rates will come down and, these retail REITs will outperform and residential REITs will outperform. But for the most part, like, I am most bullish on industrial REITs. I believe they have, the best opportunity for growth moving forward, especially with, the expansion of companies like Amazon, distribution warehouses, all that type of stuff. I am most bullish on industrial REITs. This fund doesn't really contain all that many of them, but that's also because, remember, this is an equal weight REIT ETFs. So a lot of our ETFs in Canada are retail and residential. It can't really go heavy on industrial. But in terms of top holdings, you're going to get a wide variety of REITs, equal weighted, and, a lot of the time it's going to be retail focused. So how has the fund performed over the last while? And this is, a very important element of this, because this fund has gotten, I would say borderline thrashed in, a rising rate environment. When we look to total returns, we can see that on an annualized basis over the last 10 years, this fund has returned around 5.24%. But when we go to 3-year returns, it gets quite ugly. You would have had to reinvest the dividends to lose 1.57% annualized. This isn't all that surprising, and I actually want to show you what I had mentioned, the importance of the Bank of Canada overnight rate. Let's go overnight rate. So Canada target overnight rate. And we go to normal. We can clearly see here where this fund started to draw down. So we're looking at, an ultra low policy rate. And if I actually expand this outwards, we can see that, REITs really thrived from, we're looking at, this is 10-year returns. So we're looking at 2014 up to the pandemic. Even during this rising rate environment, because REITs are not always prone to fluctuations in interest rates, drawdowns in interest rates, because overall, especially ones that are residential focused, property values typically go up with these rising rates. We did some studies over at Stocktrades for a while that actually showed that REITs tend to do well in a rising rate environment. But what changed during the COVID-19 pandemic? This rate increase that caused them to, you can pretty much line it up. As soon as they made the first policy rate increase, these REITs absolutely tanked. So what caused this? Well, primarily the pace of this policy rate increase. Look at this. We went from 0.025, I believe, to over 5%. So this is what caused the huge decline, because at this point, mortgage rates, mortgage costs increase. They balloon. These REITs can't necessarily pass off those rent costs. In the case of a residential REIT option, they can't pass those rental costs off as quick. So as a result, mortgage costs skyrocket, rents can't keep up. There's a lot of pricing pressure on these REITs. Real estate pressures, the price of real estate in particular areas has no doubt gone down. These REITs often trade based on their net asset value, which ultimately will go down as the value of properties go down. So the rising rate environment here has not done well for Canadian REITs whatsoever. And the other thing I want to highlight is, if we compare it to a fund like VRE and we go to a total return basis, it has outperformed VRE over the last while. They kind of went hand in hand during the pandemic, but post-pandemic environment, ZRE has outperformed. Now, the reasoning for this, when we go to VRE's holdings, it's structured a bit differently. When we go here, first off, it's not equally weighted. So there's a lot more top-heavy elements of VRE. It's a capped index. So pretty much just a single REIT can't make up over 25% of the total portfolio, or they have to rebalance it. And you're going to get, with a non-equal weighted ETF, you're going to get more exposure to the top-heavy larger REITs, which haven't necessarily performed all that well over the last while. So when we go here, we have Canadian apartment properties, which, pure real estate exposure. We have real RioCan, which has not performed very well over the last while. We have Granite, which is an industrial REIT. We have Tricon Residential, Choice Properties. I do like the equal weighted nature of ZRE more than a top-heavy focused REIT. It allows you to take advantage of practically the entire sector. You're not necessarily making a big bet on a fund that is more top-heavy like VRE. You know, if those top-heavy REITs struggle in light of a REIT recovery, you're going to underperform, whereas this equal-weighted fund is probably a safer bet for a recovery of the entire industry. Now, that said, has this 0.61% management expense ratio been worth it? 0.63% if you include the trading expense ratio? I mean, I would say no. The fees are a bit too high. I would say that a Canadian investor, you know, ultimately it's up to you. Again, I'm not here to tell you how to invest. That's your own choice. But ultimately, a Canadian investor could probably pick a select few REITs and probably avoid this fee. But again, as I talked about earlier with VRE, because that REIT is top heavy, selecting individual REITs, you run the risk of underperforming. I mean, we've seen a lot of cuts in the sector over the last while. I mean, Northwest slashed the distribution not too long ago. If you had bought that fund, you're down a ton of money. Whereas if you bought this equal weighted REIT ETF, you have probably, I wouldn't say come out unscathed, but you've probably, you know, the portfolio is more diversified. It's equal weighted. You're not going to get hit as badly. So I would say for a lot of investors who don't really know how to analyze a REIT sector, they're uncomfortable picking individual REITs. Just considering the, you know, niche element of the REIT itself, you're going to get high fees when you're looking at funds like this. Fund managers know they can charge these high fees because they're very particular ETFs. It's got a relatively high distribution. I mean, they're REITs, they're tax structured to pay out, you know, 90+% of earnings. So overall, if you believe that the REIT sector is going to rebound, if you believe policy rates are going to decline, this is not a bad fund to have a look at. If you're looking for a more concentrated fund in typically the larger REITs in the country, VRE is not a bad one to look at. XRE is another one that you could have a look at. This video is running on for quite some time, so I didn't actually take a look at XRE, but XRE is no doubt, it's an S&P TSX capped REIT index, which primarily focuses heavy exposure on the larger REITs. So again, I wanted to go over ZRE because it's a bit more unique in the fact that it is equal weight, whereas XRE and VRE are more top-heavy, market cap-weighted ETFs. So that's why I felt this would be the ETF to best focus on, because I feel it's probably the one that should be most utilized for people who want broad exposure to the Canadian REIT sector and not particularly concentrated exposure. Am I a fan of the fund? For people who, you know, aren't comfortable picking individual REITs, I don't think it's necessarily that bad of an option, but ultimately that is completely up to you. So I hope you liked the video, everybody. Head down below, smash that like button, comment down below. Again, next week we're going to be giving a premium subscription away and that no BS newsletter in the description. Tons of information coming down the pipeline on a REIT platform we're launching that is going to change the game for Canadian investors. You've never seen anything like it. Head down below to the link, click the description, and sign up today. And as always, stay tuned for more great Canadian investment content.